What if I told you that the biggest wealth transfers in history don't happen during a crash? They happen after it ends, when nobody's paying attention. Before every market rally, certain signs appear. Interest rates shift, fear hits its peak, and the smart money moves in while everyone is still frozen and paralyzed. I'm going to show you exactly what those signs are. In the early 1980s, after one of the most significant crashes in history, interest rates started to fall. And this was a product of a reduction in inflation. With some newfound bandwidth in the economy, the Fed was able to lower interest rates, and this set up what would be one of the longest bull runs in history. A 17-year run where if you were invested in the S&P 500, it was pretty hard to lose. And this is pretty consistent with big rallies. They almost always happen after a crash, as the Fed is lowering interest rates, trying to add stimulus to the economy and make things better. And usually that's the first sign that something big is about to happen in the markets. And this happened again post 2008 after the recovery from the financial crisis. Obviously, after there were major stimulus efforts, arguably some of the largest in history prior to COVID, which again set up a bull run that would last for years. And even though after 2008, it took a pretty long time for the fear and the anxiety surrounding investing to cool down, eventually it did. And after that fear had hit its climax, eventually people started to get a little bit more confident in the market, causing the S&P 500 to bottom in 2009, and then going on to gain nearly 100% within a 2-year period. And see, the interesting thing about this time was if you had lost a significant amount of your wealth during the financial crisis, and you had sold all of your investments out of fear that they would continue to go down, you missed out on some of the biggest trading days in history. In fact, the people who suffered the most weren't the people who weathered the storm and kept their money in the markets. It was the people who sold and waited for things to get a little brighter. But while they waited for things to get brighter and waited for there to be confidence in the market, they missed out on the days that were the signal that the market was going to get better, which also happened to be the same days that saw the biggest gains. And then there was, of course, the COVID-19 rebound. Now, COVID-19, the pandemic, led to one of the shortest recessions in history. There was complete panic for several months until people realized that it wasn't going to be as bad as everybody thought. And once again, right after there was massive amounts of stimulus from the government, the stock market rallied. And it was this combination of investor panic hitting all-time highs, while at the same time the Fed stepped in to make things better, that led to another pretty significant run, especially if you were invested in stocks that were in the tech field, ones associated with a blossoming industry otherwise known as AI. And ironically, stocks and real estate, they both boomed before the economy even reopened. Long before we got those jabs in our arms and we were able to go back to work, the stock market and the real estate market were flourishing. And this just goes to show how quickly market sentiment can shift. And if you blink, you often miss it. Which means if you sell your investments because you're afraid they're going to go down in value, and you don't stay in the market, there's a high likelihood that you're going to miss the days that allow for the recovery. And to put this in perspective, just think of the first few months of 2025, some of the biggest declines in history in the stock market in a very short period of time, followed by a complete reset that got the stock market right back to where it was 2 or 3 months prior. If you sold because you thought everything was going to hell in a handbasket due to the trade war, well, guess what? You wouldn't have made up for the losses that you suffered as a result of the gains. Which is why it's so important to have a strategy that allows you to be prepared for both the declines and the rallies so that you can take advantage of both, while not taking yourself out of the market completely. And I'll talk about that a little bit later on. But here's the lessons from history. There's recurring patterns here. In almost every single one of these scenarios, there was anxiety and fear, followed by stimulus from the Fed, combined with improvements in inflation and interest rates. Those seem to be the three things that always happen right before the market's about to rally. But there's more to it than just this. There are common indicators that almost always precede a rally, that are more than just what's going on with fear, inflation, and whatever the Fed is doing at any given time. Because when interest rates start to fall or stop going up, and inflation starts to decline, these are an early indicator of stabilization. And you'd be surprised at just how little of a shift in sentiment the market needs in order to explode. But there's more to it than just that. You can start to see the volatility disappear in the market when the massive declines start to slow, and groups of stocks, different sectors, start to rise together. It is often a sign that the rest of the market could potentially follow. Just think about this with AI and tech stocks in early 2025. Stocks like Nvidia and Tesla led the market, And the rest of the market, even though it might have been suffering, well, it kind of followed along. But most importantly, the volatility started to come out of the market. And there's a really great indicator for volatility. It's called the VIX or the VIX. And you can literally watch this. It's an indicator essentially of market sentiment. And when the VIX is high or volatility is high, that's usually an indicator that there could be a massive shift in the market or multiple massive shifts. But when it starts to settle down, that's usually the beginnings of a market rally, or at least a stabilization. And the VIX usually starts to settle down as investor sentiment goes from very pessimistic to slightly more optimistic. And when this happens, and there's been a whole bunch of cash sitting on the sidelines, you start to see investors feel a little bit more comfortable with putting it into the markets. Now, this also happens almost simultaneously as all of those people that you wouldn't expect to invest in the markets start to leave. The same people that told you you need to invest in A, B, or C stock because it was a no-brainer and you couldn't lose, well, they've given up on the stock market completely at this point. So the serious investors and the long-term investors are still there, but the fanatics, the short-term investors, the day traders, they all tend to go away. And as things start to get better in the economy, things start to improve, the better economic conditions, which can be interest rates, inflation, jobs, employment, or in some cases, even business profits, create even more comfort in investing. But this isn't always easy to see because the market sentiment in the moment, right before the rally, right before stocks explode, is usually at its lowest point. And for some reason, this is the point where institutional investors say, okay, everybody's really scared. It's time for us to jump back in. And they do. And if you miss this moment, you missed out on the opportunity to have the biggest gains, to recover any losses that you previously made, or to transfer any wealth from the others to yourself. So the question then becomes, how do you prepare for the next rally? How do you make sure that after a crash, you don't get scared, sell out, and then miss out on some of the potentially biggest gains of your life? Well, it turns out that the answer to this could very well be the all-weather portfolio, which was created by Ray Dalio. It's a diversified investment approach that works in all economic conditions. But more importantly, while it does diversify for asset class, that isn't the most important thing it's diversifying for. It's diversifying for risk. And this balances your exposure to stocks, to bonds, to commodities, things like gold, so that when the ones that are performing are overvalued, you rebalance and buy more of the ones that are undervalued. It's a really simple process. And more importantly, it keeps you in the market when things get bad and causes you, because of the rebalancing, for example, selling something like bonds when they're overvalued and buying stocks after they crash for way less than what they're worth. And as a result, you end up reaping the rewards. You put more of your money into the things that have the potential to go up significantly. And when something like stocks become overvalued, you take some of the profits, you put it into bonds, which would probably be undervalued at the time. And that's essentially like taking some cash off the top and preparing for the next crash. It's an absolutely brilliant strategy. And even though the all-weather portfolio doesn't always perform as well as the S&P 500, over a very long period of time, it almost always outperforms. And it does so with limiting the drawdowns. The drawdowns being the amount that you lose when the market does crash. In fact, if you had invested in something like the all-weather portfolio during the 2008 financial crisis, you would have lost significantly less than those who were just invested in stocks themselves or the S&P 500. But the reason that it really works is simple. It manages risk. It keeps you out of the stuff that's overinflated and keeps you in the stuff that is undervalued. Every time you rebalance your portfolio, you're setting yourself up so that if there is positive economic conditions, you'll gain the benefits from stocks. And if interest rates are falling, well, you're going to gain the benefit from the bonds. And keep in mind that interest rates are typically falling right after a crash, right after a recession. And of course, commodities, they tend to do well after the point of maximum fear. And the asset allocation for this is really simple. 30% stocks and bonds, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, and 7.5% in commodities. And your goal is simply on a monthly basis to make sure that the amount that you own of each is in line with the target allocations. But the real brilliance behind this strategy is that it keeps you from doing the wrong thing at the wrong time. Yes, you rebalance regularly, but in doing so, you take all of the emotion out of it. You're just trying to hit the allocation targets. It's that simple. Now, if you set this and forget it and you only look at it on a monthly basis, it works perfectly fine. But here's the thing to really watch out for. You can go one step further and rebalance at the times when things hit their ultimate peak or their ultimate valleys. So even though it may not be your normal time of the month to rebalance, if all of a sudden there's a moment of peak fear, that's a good time to go in, look at your portfolio, and rebalance then. And when it looks like things are about to recover, just do a double check. And whatever you do, don't put all of your money into one investment. Don't stuff it all into gold or Bitcoin or one single stock, because no matter what anybody tells you, there's no guarantees. Oh, and by the way, if you want to see what always happens before a recession, which is the opportunity for you to make probably the most money because everything's going to be undervalued, make sure you check out this video right here.